What if your goal wasn't to just hit a retirement number, but to instead own assets that pay for your expenses forever? That's the core of my infinity income model. In this video, we're going to layer together 3 powerful data sets that have been out actually for about a year or two, but we're going to be going over things like average net worth by age, the average spending patterns for people, especially the 55 and above, and the average retirement savings by age. And then we'll show how to use them through the lens of infinity and income so that your assets become your paycheck and you stop worrying about this whole idea of running out of money. We don't want that in your life. I don't want that in my client's life. I don't want that in my life. So let's jump into it. All right, we're going to use this information to help us implement the 4 steps at the end. So stick with me all the way there because we're going to start laying down what the data means and then we're going to use it. So let's start with that data. In a recent Kiplinger article, they dove into the average net worth by age using the Fed Empower data, and it shows that the median and the mean diverge significantly. The median is the midpoint, the 50% if you will, while the mean is the average. So if you have, let's just use it as an example, let's say we have 10 people, right, and 9 of them have saved up 100 grand, but 1 of them has $1 million. Well, the median net worth would be 100,000, that 50th mark, the 50th percentile. But the mean, which is the average, would be 190,000. Now you put that on steroids and you get where we're at as a country. Like we have the really rich, and then we have everybody else. So in the Federal Reserve Survey of Consumer Finances, this is 2022 data, they're going to come out again in 2026. So this is the most recent data we have. But they reported that the median net worth, the median for the U.S. was 192,700. So that's the midpoint. The average, however, was skewed up in for folks that are, this is actually the total number, so it's not even looking at ages yet. But the average net worth was over $1 million. It was like $1,059,500, which means we're really skewing these numbers upwards on those averages. So that mean isn't what we think it means, right? Pun intended, right? We want to be focusing on that median, where that 50 is, to give us a better idea of where we're at. So in your 50s, the mean net worth is 1.285 plus some change million. So close to 1.3 million. While the median, get this is that midpoint, is 190,000. This just means that the rich folks are really skewing the numbers and it isn't helpful for what we want to achieve. My takeaway, many people overestimate what the average means and misjudge their standing. A lot of people will just let go. They're like, I'm not anywhere near average. Well, hold on for a second. You're very close to that median number, right? The midpoint. That's what really we should be basing ourselves on. Let's shoot here. If you get up here, that's great. If you want to be a richie rich, that's great, but it's really skewing the numbers. Then we go through the Empower numbers, and they use a dashboard, and they did an illustration per decade, and this is in 2025, so this is pretty recent. So we have in our 20s, just so you have the mean, the average is $113,000. But the median, the 50th percentile, $6,511, right? So if you're in your 20s and you have some money saved up, you're already above average more than likely, right? You're already doing great. In your 30s, I'm just going to call it the average just to make it easy. I'm just going to say the average was close to 300,000, it was 289,000. The median was just over 23,000. That 50th percentile. Again, we're talking about a 10-fold difference between the average and the median. We're that midpoint. 40s, now we're getting humming, right? The average was 708,000 and some change. The median was just over 74,000. So that midpoint is right. If you're in your 40s and you have $75,000, you're above the midpoint. Then you go to the 50s. And this is the kind of the age group where if you want to retire early, this is where you should be doing it. Like, there's the fire folks, the financial independence, retire early, trying to get retired as quickly as possible. I get that. I understand it. But where we actually have the reality of it is probably closer in your 50s and 60s. So the average, that mean number, is 1.285. 1.285, close to $1.3 million. And that median, though, is right around 190,000. So that midpoint, 190,000 again. 60s, let's go in, now we're really cranking it up. And this is what's funny, it goes up in the 60s and then down in the 70s because people are spending it down during their retirement years. Usually towards the end of life you have health expenses and things like that that might add up. And we'll talk about that in a second. But the 60s was just over 1.5 million on average. The median was 290,000, just over 290,000. So again, that mid-level, and again, this is just for comparison's sake. It's going to make you feel a little bit better about where you're at, unless you're doing really, really well, in which case you're looking at this video in amusement saying, I'm killing the average, right? You're skewing everything upwards. 70s, the average is 1.42 million, and the median is 232,000. So it drops from the 60s to the 70s, again, because we're spending it down. So then what we can jump to is looking at the average retirement savings. And this is again from the article from Kiplinger. And this was derived from the Federal Reserve as well. And this is a bit more meaningful, as there are savings that, when you have retirement savings, they tend to be more liquid, right? Versus having a valuable house. Your house could really screw these numbers because it's considered an asset towards your net worth. I don't use it towards that, and we'll go over that in a little while, but a lot of people do. And if you remember 2008, if it taught us anything, is that it sucks to be real estate rich and cash poor, right? That's what that really taught us. I got $1 million house, but I could only sell it for $200,000. Yeah, you don't have $1 million house, but it's $1 million. It appraised for that. Come on. Right, so here's the key numbers from this study. Between the ages of 35 and 44, the median retirement savings, the median was the 45,000. The mean, the average, was 141,000. So again, you see this big skew. The average between 45 and 54 ages, the average was about 313,000, whereas the 50th percentile was that 115,000. So this isn't nearly as bad as net worth. I'm just kind of pointing that out right off. Like, this has definitely softened the blow. So there's retirement savings. Let's go to people that are 55 to 64. Again, the average, the mean was 537,000, a little bit over that. The median was right at 185,000. When we go to ages 65 to 74, it's, again, average 609,000, so it's gone up. Nice, right? This is weird, right? And the 200,000 is that midpoint. So you notice how the median retirement savings are very modest compared to the net worth averages. Many retirees carry significant wealth outside their retirement accounts, like their homes. Some might have a business or something else that's going to skew the numbers. So these retirement savings are much more benign, right? Also, when you compare retirement account balances to net worth figures, you see that many people's net worth is not in liquid assets. It's a lot of them, they're tough to get to. It's not in retirement accounts or liquidity on your net worth necessarily, but in other assets, right? Additional context. The average 401k balances and IRA balances also show this similar variation. Now, let's go through a third key input, which is the average spending by age for folks that are 55 and up. And this is, again, Kiplinger's analysis. Some typical average spending categories. And I'm just going to kind of just say these out loud so you get an idea. But you're going to have an age, whatever the age band is, but you're going to be looking at housing, health care, transportation costs, food and entertainment, and other. So what are they spending? Let's just kind of go over that. It's in the housing, 25,000. Like, again, so let's go over the category. I'll say it's 55 to 64. That's the one I'm really looking at. You're looking at 25,000 dollars for the housing. Healthcare is probably $7,000. Transportation, things like that, you're talking $14,000. Entertainment, your food might be somewhere around the $10,000, and then others might be $4,000 a year. When you add all those up, you're looking at around $60,000 a year, which is in line with what we saw in other studies, multiple other studies. But it's right around that $5,000 a month mark. I'm not going to go through the other ones. I'll put them up on a screen so you can actually see them. But these numbers tend to be approximate, but they're consistent with what we've seen from other sources. So when you start looking at it, yes, your cost of living starts to drop, and you may actually end up, and again, if we're just talking about what the average amount that people are spending or what it typically costs to live, I always call it's like your needs, wants, and wishes. My needs might be satisfied at this $5,000 or $6,000 a month mark. And a lot of us think we need more. Well, that's because we have wants and wishes, right? We have other things that we want to do. We want to buy the boat, the RV. We want to go on lots of vacations, and that'll drive it up. But here's some key observations on these studies. Number one, that housing is the single largest expense in early retirement, but it declines later on. And that's probably because people are paying off their mortgages, or maybe they're downsizing, or maybe they're relocating, right? Maybe they're going to go live with family members, or maybe they're going to be in assisted living, and maybe that's covered by a long-term care policy, or they have a long-term care rider on their insurance and it's covering it. The other thing we see is that health expenses tend to increase modestly with age, and we know that, right? The older we get, the probably we're going to be spending more on these things. The discretionary categories, which is really like your transportation, your entertainment, and food, tends to go down in later years, right? You may not be able to do the same things as we get older that you were able to do before. And this is an important kind of an insight, and I've heard this from plenty of others. They call it a smile. Your spending curve tends not to be flat. It tends to start off and it kind of goes, when you retire, you spend more, and then it dips down, and then it kind of goes up towards the end, right? They always call it kind of this smile. And that is what we see. The more expensive years, like when you're traveling and you have an active lifestyle, might be front-loaded. When you retire, that's when you buy the boat, that's when you buy the RV, or you're going on these vacations and you're spending it. And then at the end, we have more expense on our health care and things like that that may cause us, and it kind of dips down. So here's where the data meets strategy. If all you do is chase a magic number, say I need $2 million for retirement, you risk either overshooting, like you've worked too long and you've overshot it, or undershooting, running out of money, right? And that's, I've lived this. My mom was sitting there, she's in her 80s, and she was seeing the end of her money. Like she could see it, hey, there it is. I don't like that. The infinity income model is different, right? Our goal is to own enough assets that those assets pay for your expenses year after year, no matter what happens. And I'll draw it up like this. Let me just show you what it looks like, right? I always use little boxes. I might have my income. I might have my expenses. And this is your income sheet. Like if you were doing a mortgage, they're going to say, you know, we're interested in your income and expenses. This is what we're trying to do it. Then we have your balance sheet, and this is where you get your net worth from, right? And this is your assets versus your liabilities. And just to tell you how I use these numbers, income minus expenses, so I minus E equals your spread. Whenever I'm working with younger people, especially, I'm saying, what's your spread? And if we're building up and we're trying to build up our assets and we're trying to use that to buy assets that create income, that's what we're looking at. If I'm doing net worth, assets minus liabilities equals your net worth, right? So, hey, I'm looking at my assets. Now, here's my problem. The way I define an asset is very different than the way a bank or somebody else may look at an asset. They may say your house is an asset. I look at an asset as an asset feeds you and a liability bleeds you. An asset puts money in your pocket every month and a liability takes money out. So when I'm looking at it slightly differently. But what we want is these assets to create income, and those income to cover those expenses. So I want your assets to be covering all your expenses so that you never have to worry about working. I don't need me up here to work. You don't need my labor to create income. I'm just going to let my assets do it. So we'll get into that. So infinity income simply means I want to buy or build income producing assets, dividends, real estate with net positive cash flow. I want royalties, things I could do oil and gas, right? I could have business. I could have things that are producing income, stuff that I love. I love things like dividend producing stocks, writing covered calls, doing the wheel strategy when it comes to the stock market. I love things like rental real estate or REITs if I don't want to buy a house, if I'm doing multifamily. I love self-storage, things that produce income streams from there. I also like private credit. I like some things that can create interest. I even like muni bonds and things. Tax-free income is always great. But the whole idea is that these income streams replace or cover your expenses. So your principal, we're not spending this down. You'll see we're never cutting into it. I do not want to say, like when you pass away, the idea is that you don't have zero assets. The idea is that your assets are continuing to create and cover expenses. And then when you pass away, that income stream, it's almost like having a gumball machine. Let's say you lived off of gumballs and you have a gumball machine. Or better analogy might be a chicken that produces eggs. That now I can eat the eggs. I can live off of the eggs, right? I could give that to somebody else. I could give it to my heirs. I could put it in trust so that it just kicks them income so they can't mess with it. I could give it to organizations I care about. But the idea is that it's an infinite income stream. Once you build this up, once you have a cash flow machine, it doesn't go away. And as long as your income stream keeps up with inflation, or it's going to grow as inflation. Like if you have rents, they go up with inflation too, right? Your lifestyle then is sustainable. So as long as you have these income streams. And yes, the income sources that I like to focus on go up with inflation. So we aren't worried about that. I'm not worried about that. And then you have other income as well that a lot of people, when they retire, they're immediately talking about Social Security. But that is gravy in our world. In other words, I'm not banking on Social Security. It's a nice bonus, but your goal is to not need it. So when I look at net worth data, retirement savings data, and spending data, what I would be asking is what income does that asset base have to produce the cover for your spending? Let's suppose that you have somebody in their early 60s with a net worth of $1 million, right? And what yield must that portfolio produce to cover? Let's say that they have $50,000 a year that they need, or $60,000. That's a 4 to 6% yield, depending on whether it's 40 or 60,000. If your income producing assets yield less, let's just say that they're producing 2 to 3%, you're doing bonds or you're doing something along those lines. You either draw down your principal or you downsize your lifestyle, and that's what the problem is. So the magic number is less meaningful than having enough income yield, and that's why so many retirees struggle with even a decent net worth or savings. If their portfolio is in sleeping money, it's illiquid, it's not producing things, it's in my house, it's not serving them, and that affects the retirement. So the goal is to tilt as much of your wealth into income producing assets, to tilt as much of your wealth into those income producing assets as is feasible, with diversification to protect against like a yield collapse or a cycle where the market draws down. So here's how we take the data we just reviewed and convert it into a plan under infinity investing. And I'm going to go through these and then I'll go through your 4 steps, right? So the first thing we do is we quantify your spending curve. You start with your current expenses and then overlay likely changes by age. So your health, your housing, your travel, things like that. And you could use the Kiplinger data, right, as a guide. Like we can take a look and say, what's the average amount that people are spending? And we could see when it goes up, when it goes down, when it starts to go up again, to give yourself an idea. And then you can estimate the income that's required. So for each year or phase, what you want to do is you calculate how much income needs to be generated from the assets. So it might be, X dollars per year, and then maybe I'm going to add a little bit of a margin, a little bit of a buffer, right? What I want to do is say, here's what I use needs, wants, and wishes. Some people do this. The minimum amount that I need is for my needs. It covers my overhead, like make sure I have a roof over my head and food, right? But if I want to travel and go to movies or go to shows or whatnot, then I might need some more. So what I do is I add a little bit of a buffer, right? And that gives me the ability to say, this is the number I want to hit. Then you would audit your current assets and look at their income yield, right? And you want to be able to distinguish assets that produce income, your dividend producing stocks, your rents, royalties, things that are producing income, versus assets that do not, right? Like land, having something that is losing money in real estate or collectibles, right? There's no money that's being created from these things. And that's why I say assets feed you and liabilities bleed you. I would also say there's another category, which is cash or cash equivalents, which don't do anything, right? They don't really cost you anything. But, like let's just say that you have a collectible car, right? It's going to cost you something to maintain it. Maybe you have to register it once in a while if you want to drive it. You have to have insurance on it, things like that. That is a liability in my world, right? And so if you have those types, then we want to quantify what they are. And then we want to convert non-yielding assets, things that don't produce income, into yielding ones, right, where we can. We want to move it so that these assets are actually kicking out income. We want money. It's not enough to own an asset. We want it to be producing. So then you select and scale income producing assets. Like again, I love dividend stocks, dividend ETFs, REITs. I tend to focus on things that have been increasing the amount that they're paying out for long periods of time. So I tend to focus on dividend aristocrats. They've been increasing their dividends and payouts for 25 plus years. Dividend kings, these are stocks in REITs that have been producing, increasing the amount they pay out to their owners for 50 years or more, right? In some cases, it's 60 plus years at this point, where they pay out their profits. They're just giving it. Well, I can spend that money, right? Then if you want to continue to increase how much income, you might be doing covered call strategies to produce more. You might be doing cash secured puts so that if I have money in an account, it's not just sitting there, but I'm scared to death to maybe have it in the stock market. Here's another way that I could produce it. Or you're looking at certain types of hybrid assets. Maybe there's private credit, there's ground floor Prosper, there's Blue Owl, there's a bunch of these things that might be available to you depending on whether you're an accredited investor or not. But even if you're not, you can still get into them. But certain things start to open up, and you might be looking at these things that are producing extra income. So for example, Blue Owl, I think it's been close to 10% every year. I do some stuff with Spartan where I'm getting 9-10% a year on some private credit and things like that. It's all up to you. When I'm doing Prosper, I think I've been a little bit over 11%. And you're doing private credit. Yes, there's still risk involved in that, right? But you're looking at the yield. I'm looking at the asset and is it paying out income? And then you manage that yield risk and you preserved principal. What we don't do, we don't chase ultra high yield. We're not just looking at it going, I want the companies that pay the highest amount of dividends because they may not be the best company to be investing in, right? So you don't chase ultra high yield without regard to risk. You want to balance safety and diversification. As the older you get, people tend to go into less risk. So like I'm a high income person, so I do some muni bonds. Yeah, because I can get, when I'm getting 4.5%, 5%, that's the equivalent of making 8%. Some of you guys might say 8% is not that great. Trust me, when you get to the point where you're sitting there going, I just don't want to break the machine. I have an income producing machine. I don't want to break it. Then those things start to look really attractive. In my what I actually receive, and I'm a tax attorney by trade, so I look at these things very differently. I say it's not what you make, it's what you keep. If I make a 10% return, that might sound great, but if I'm giving half it away in taxes, it's not really that great. So I might be looking at something that is going to produce income where it's my after tax-free yield. This is great. Or I might be looking at my HSA, saying, boy, this is great, I want to be doing that. Or your Roth IRA, you're starting to look at those things. And they are part of the calculation. But for our purposes, we just look at assets, are they producing the expense? Then we also want to have some dry powder. Cash. Have a safe bucket for if the market downturns. Because what happens to people is they retire and they have their money in the market and the market starts to pull back. They freak out, they think about selling, or they're forced to sell because they don't have income producing assets. Their market, the way that they live off of these things is they sell things. And if the market drops 38%, which it's done before, right? If you remember gosh, 2002, 2008, all these, we had these, and then COVID and boosh. Like if you were forced to sell to cover your expenses, and I know people that had to do it, it sucked because you had this drawdown and you're getting 60 cents on the dollar, 70 cents on the dollar. So then you want to look at it and you want to make sure that you're focusing on the type of asset, your risk, and you want to ladder or straddle some of those withdrawal sources. You don't want to just drain one type of income source first, right? You want to have this thing spread out. I use 30, 30, 30, 10, and that's what we use in Infinity. And by the way, I never mentioned this, but if you go down into the comments, you've been listening long enough now, so you're committed, type free book into the comments down below and I'll send you a link so you can get a free PDF of Infinity Investing. I wrote a book on it. It was an Amazon bestseller, got a Global Book Award, got a gold medal. And you can go to Amazon and read the comments on it. It's still in bookstores. But if you want a free copy, all you have to do is type in free book down below, and I'll send you a link. And then you go to the link and you can download the PDF, right? All right, next step. We monitor and adjust every year. This is kind of like a minimum 1 year. Some people do it quarterly. You compare your actual income from assets and spending, and you're just looking at it and closing. So I want to know what your income is. I want to know what your expenses are right now. Like, what do? You go pull your bank statements, you go pull your credit cards, and we're saying, how much are you spending? How much do you have coming in? And we compare those. We want to do the same thing with our assets and liabilities. And then each year you compare that, and you look at it and say, are my assets creating enough income to cover my expenses? And you want to keep closing that gap. If your income falls short, catch it early. And then you have options. You adjust your spending. Like a lot of people, that drives me crazy. You know, Dave Ramsey, eat rice and beans, which I don't think he literally means eat rice and beans. He means, you know, tighten your belt and really don't spend a lot of assets. I hate that for folks that are in retirement. I just hate to see that, right? I'd rather you not have to do that. And that's why I look at it. If I have enough assets covering that, I don't have to do that. But let's just say you do. Like, we're going to be realists, right? Adjust your spending, shift assets, monetize illiquid assets, and we want to get into this idea that I have enough income being produced off my assets that I never have to work again. So you want to pay attention in the three categories: needs, wants, and wishes, to keep yourself sane, right? I don't want you guys doing this minimalist mindset. Oh, I just have to spend so little. Figure out what you spend and what makes you happy, and then target that. You might be surprised. When we look at the Kiplinger articles and the data from Empower and from the Fed, it lets us know what everybody else is doing, so it kind of keeps us sane. And what we think we spend is often different than what we actually do spend, so it's important to actually quantify this at least once a year. And again, the data from Kiplinger paints part of the picture: what people own, what they save, what they spend. But the real power comes when you transform that data into an income generating plan. I want to create, what is my plan? Well, here's an easy 4-step plan. If you've gotten this far, you get a star. Remember, if you want the book on Infinity Investing, just type in free book down below. But this is it, 4-step plan. Know your numbers is step 1. Track your net worth, your assets, money, your liabilities. Make sure you know what your income spread is. Compare your retirement savings to your age group's averages from, I'll make sure that we post the data so you can look at it. So you can do a sanity check, and you look at your expected expenses in light of this spending by age data that I've shared with you. And this shows you a starting point so you can target your income needs, right? I don't want to hear somebody saying, I spend $40,000 a month, I'm always going to need $40,000. Come on, let's do a little bit of a sanity check. Look at what everybody else is doing and what the people before us do. Look at yours, actually quantify it. It's actually pretty tough to have a huge spending habit unless you're like addicted to shopping, maybe then. But if you're just talking about my needs and wants, right? If that's all it is, my needs and wants, like I need a roof over my head and food and things like that and transportation, it might be a lot cheaper than you realize. And then now I'm really focusing on my wants, things that I want to be able to do. That's fantastic, but it'll give you peace of mind because the worst case scenario, we go through another 2008 and all heck is breaking loose. You know that you're not having to sell things off. Step number 2, separate your assets into the infinity asset classes. So I want to make sure that I know what my assets are versus my liabilities are versus my cash and cash equivalent. So you identify which assets produce income today, like dividends, rents, royalties, things that are being kicked off that I don't have to work for, and then you identify which assets are not income producing. My home is a great example, unless I'm house hacking and renting out part of it, but raw land, collectibles, and figure out which assets, what are actually assets, and which are actually liabilities. You might be surprised when you start doing it and basing it off of which ones produce income versus which ones have costs. And this is where you see what's actually feeding you versus what is just sitting there. And then identify what is neutral. Now, when I say neutral, I mean cash or cash equivalent. So your savings account is actually producing some income, right? But the stuff that's just sitting in a checking, gold, silver, and all the gold people that get mad at me because every time I say gold isn't producing anything, right? I can't live off of my gold. If I have a bunch of gold bars, it's not paying. I have to sell the gold to turn it into cash to allow me to pay for things. It's not producing stuff. Bitcoin is another one. Unless you're staking and you're starting to generate some stuff off of some of your crypto, I still put Bitcoin and things like that in that category. Yes, it's gone up tremendously, and I own Bitcoin. I'm not saying don't own Bitcoin. I'm just saying I can't live off of my Bitcoin unless I convert it into cash. I have to sell it, and that's not what we want to do. The idea is that we don't sell anything. The assets are producing income just by having them. And then, of course, U.S. dollars, which if I showed you the chart on the U.S. dollar, it's just gone down over the years, right? It was somebody who thought they were a really good idea to put $100,000 in their safe in 1980 because it was worth so much money, and now you find it, and you're like, years later, it doesn't have the same purchasing power, right? You're better off if you're going to stick something in your safe. Gold, Bitcoin, cryptos, those things have proven to be just absolutely monsters as well. But it's not an asset that feeds me. I want something that's actually going to buy my groceries, and so I'm going to focus on those. Then we do step 3, which is build infinity income streams. Shift more of your wealth into those. Rental real estate with positive net income, dividend stocks and ETFs. And then you find multiple ways how to make multiple streams of income on your assets. And so you might be doing covered calls or option overlays. You might be doing private credit. You're doing these things where you're creating additional income streams. And the goal is to cover your annual spending with your annual income off of those assets, not from you. If you want to work on the side, if you want to have a side gig or whatever else, that's gravy. Your Social Security ends up being gravy, but we want the assets that you have to cover your expenses, and that's what we do. So your annual spending, the expenses from your annual income. All right, step 4, stress test it and adjust annually. Once a year, just take a look at it. Look at your spending curve. Look at, compare yourself, your spending habits now versus what you've had in the past, if you can. Like, the longer you do this, the easier this gets, right? And then also look at the spending curve, because your housing expenses are probably going to go down as you get older. You're going to pay off things if they're not already paid off. And I'm a super anti-debt person. I don't have mortgages. It just drives me crazy. on a primary house and things like that. And I know that some of you guys are like, but you're crazy, Toby, you should be levering that. Yes, I get it, but I'm just one of those weird people that I like to know the only thing I have as expenses, my insurance and my property taxes. They're still there, right? But that, for most people, they're paying off that mortgage as they're going into their retirement, and it's going to go down. But your health expenses could rise. And how do we do that? How do we address that our health expenses might go up? That's where you use the HSA. That's where you use the Roth IRAs, things where they have tax-free growth and you get the money back out. But also, you want to make sure that you have things like long-term care insurance, or you could have a permanent insurance plan that has a rider on it that I could borrow against to pay for some of those things. So that's that infinite banking. There's plenty of videos on those things you'll see on my channel. But a lot of the times what I'm looking at is I'm saying, can I get access to cash to cover these things so that I am not paying for it? And if the answer is yes, you want to calculate that and you want to put that in. And then you do your kind of your what ifs. Like, what if there's massive inflation? Well, if you have a bunch of assets, they should get buoyed up. But you still look at it. What if I get sick? What if I have a major medical, or me or my spouse? Where would I access funds, or what would I be able to do? So I'm going to be looking at insurance. I'm going to be looking at my life insurance to see if I could access there. Maybe I have long-term care. And by the way, in my family, both my parents needed long-term care, right? Market downturns. Hey, what happens if the market just, right? What would happen to me? And this doesn't mean that we take a ton of action on some of this, because most of these things, they're built in with the assets. The rents tend not to go down. Like I remember 2008, 9, and 10, I had rental properties. Rents went up. For those of you guys who were landlords during that period of time, it wasn't everywhere, but on average, rents continue to increase. And then you rebalance this annually to keep your income greater than your expenses. That's what we want to do. And this keeps you resilient and prevents anything like lifestyle shock, boosh, and you're not prepared. This way, I know what I'm spending. I'm able to keep covering it. If my spending goes up a little bit, I know that I just need to make sure that I'm putting money into assets. And how am I getting more money into assets? Well, it might go like this. I'm using my assets to buy more assets, right? It's going this direction. It's literally, I'm doing that, and, so that I've done this. I did a video, I think it was the 3 steps to building a passive income empire. It's on my channel. It's got millions of views and everything, but I say, like, sometimes you lever. And there's a difference between having debt, bad debt, which is on something that's a depreciating asset, something that has it's going down in value. When I say depreciating, all my real estate guys are like, what did you just say, Toby? Because you know the real estate depreciates. I'm talking about assets that lose value over time. Real estate goes up, but you have leverage on assets that are feeding you, right? And I'm okay with that. I'm okay, like if you're buying an apartment building, go ahead and get as long as the apartment building rents are paying for that leverage, I'm okay with it. That's good debt. Bad debt is on my cars. Like if I get a loan on a car, drive it off the lot, brand new car, it's lost a bunch of its value. If I have to liquidate that thing, I'm going to get beat up on that. That is not good debt. Or credit card debt, this high interest rate stuff, just not that. So anyway, I'll just leave it at this. With the infinity income model, your wealth doesn't have to be a number that you fear. It doesn't have to be something where you're like, oh my gosh, I'm not there. It just becomes a machine. I'm building a machine that feeds your life. And that's what it is. I'm building the machine of assets that feed me, so I don't have to work. I can do whatever I want when I want. If I want to go on vacation, I go on vacation. When I want to go see the grandkids, I go see the grandkids. Whatever it might be, fill in your blank. And it's easy for you because you already have the machine. You already built the machine. So if you found this information useful, different way to think of things, then I ask you to do a couple things. Number 1, like and subscribe, and hit the little bell so you don't miss the future videos, because we will dive into, I'm constantly going over dividends, real estate income, different option strategies. So if you want to focus on this and what type of income streams can come over there and take over your expenses, it's in here. And the other thing is, type in free book. I'll send you a free book, The Infinity Investing. And we do courses on weekends, a lot of times on stock, a lot of times on real estate. If you want to learn how to build up income, these are free events that you can come to and learn the strategies that we use. And I invite you to do that. So I will see you again. Share this with somebody that you care about, and I'll see you later.